really hasn't gone anyplace. I mean, as of yesterday, you look at the NASDAQ was up 37%, but you take out those 8 stocks.
Yep.
We'll get to the Magnificent Seven here in a second. But essentially, you take those out, the market's up 7%. So it's really gone no place. The Dow's up 2.5% or 3%. So those 8 companies have controlled the market. But interesting enough, then you get to 3 weeks ago, I guess we came up with the new slogan, Magnificent Seven. Netflix went out. But that made me think to go back to 1960 when the movie was made, The Magnificent Seven. So I'll give you something to think about here is in that movie, the ending, they hired 7 gunslingers to help protect the town, and there are only 3 left. So you tell me which 3 of the 7 are going to be left.
So what do you do with a market that has that lack of breadth? I know you guys at Hennessy are value investors. So how do you approach this market? How has it changed maybe over the last several years?
Value is a place that you want to be if you want to play again.
Okay.
So look at the S&P 500. You're talking about Apple is over 7% of that. 13% of the NASDAQ. And if you think logically, would you put 13% of your money in one stock? Probably not.
Right.
Okay? So, but that's what people have been doing. At some point in time, just like the late 90s when all the value managers were getting fired because if you weren't 23 years old and you didn't have a .com on your forehead, you were fired.
Yep.
But essentially, I love the mid-cap arena, like the Hennessy Mid-Cap 30. And the reason I like that is mid-cap stocks have really outperformed everything over time. And they're large enough to withstand an economic tsunami. They're big enough to make an acquisition that would be accretive to them, but from a smaller company, but they're also big enough to be acquired by a larger company and be accretive there. And so you see a lot of value in that mid-cap arena right now.
What stocks or industries in mid-caps do you like?
Well, energy's there. But I mean, if you look at names that people don't associate too much when you get the radio, TV, or something like that, is Comfort Systems. Big deal. But most likely they did part of this building because they're industrial and building and putting in the ventilation, heating, air, things of that sort. They earn $8 a share and pay $1 dividend. So logic would tell you there's plenty of room to raise the dividend.
Stock's up 70% year to date. So good call for a $7 billion market cap company. FIX is a ticker.
Yeah, and then you can look at Sprouts Farmers Market.
Wait. This is a public company? Hold on. I'm going to go ahead. I'm just going.
Sprouts.
Popping up on the terminal.
Okay. It's farmers market, and truly, when you walk into the store, you feel like you're in a farmers market. There's produce all over, and if you think about inflation, food prices that have gone up, and you go, well, geez, do I really want to get into a specialty market like that or Whole Foods? Well, there's a big difference between Sprouts and say Whole Foods, and that's simple that. You look at the produce and you look at the vegetables and stuff, and you just add a little bit of pasta, and you can make a very cheap meal for a family. And that's their niche. They have about 300 stores, mainly on the West Coast. But, here's this company that makes $3 a share and doesn't pay a dividend. So, there's so much value out there that you just keep looking for it and then buy and hold it.
SFM is the ticker there.
Yes.
Up, it's got about a 4.3 billion market cap, up 30% year to date. How do you guys at Hennessy define value? I mean, is there a PE threshold? How do you define Sprouts Farmers Markets? I know an analyst didn't come to you and say, hey, I just went into this great farmers market. I think we should buy it. So I'm guessing you guys screen here.
Well,
you're
right. Everybody has, every money manager has a formula.
Yep.
Okay. And we have a formula, and what we do is once a year, we rework the formula. So essentially, it's looking for companies between $1 and $10 billion in market cap. We're looking for increase in earnings. The main point being a price to sales ratio of 1.5 or less. So we're not going to pay more than $1.50 for $1 in sales. And that's where the value is. Because earnings, just like anybody, you can manipulate earnings by taking a write-off or adding this or taking a gain. And earnings don't pay your bills. cash flow pays your bills. And so when you start to look at a truer number, unless you're going to do an Enron, it's sales, right? And so we won't, like I say, pay it more than $1.50 for a dollar in sales. Now you take those magnificent, easy for me to say, the 7 or 8 stocks, and you're looking at a price of sales of somewhere in the 9 to 10. So they're buying, they're 8 times what our threshold is, at least.
What are you selling?
Well, we're not selling anything, because when we do this formula, at the end of the formula, we buy the 30 companies, okay, that hit the list, and essentially buy them in equal dollar amounts, hold them for 1 year, and then readjust the portfolio to then the 30 stocks that hit our list and buy them in equal dollar amounts. But the last stage of that is we're looking for companies that have, or stocks that have price appreciation over a 3 to 6 month period, and then we buy the top 30 that have the best price appreciation after 1 year. And you sort of ask, why would you do price appreciation? Aren't you just chasing the market? The reality is, really smart managers, more than me, they've been buying these companies for a while. They've just been holding their hand little by little by little by little. So over a 3, 6, 12-month period, it goes up. So we're not catching it in the first inning.
Right.
We're catching the stocks in the 3rd inning, 4th inning, which is where you want to be.